looking into some of your individual stock check-ins, we've talked about SoFi, NEO, Open Door in the show before. All three are getting crushed right now. So, what's your advice to investors right now?
Okay, so let's go through those three. Open Door, NEO, SoFi. Let's start with Open Door. I love Open Door long term. I think iBuying's the future, but it is navigating through, and I have a lot of pity for the execs over there. They are navigating through the most confusing and volatile housing market ever. 2008 was a worse housing market, but it started declining and it just declined. Like it was pretty. If your model said decline, it was declining. It wasn't that hard to forecast. It was going to decline. We're in this weird market. Like today, new home sales just reported, and they smashed expectations and jumped month over month. It's like, wait, what? Like, home sales are supposed to be crashing. Home prices are falling, but then new home sales just jumped. Like at the first sign there was a housing price decline, new buyers jumped in, despite mortgage rates jumping to 7%. Yet affordability is at all-time lows. Yet the housing inventory is at all-time lows. Month supply. There are so many conflicting signals in this housing market right now. So many conflicting signals that to be a company that buys homes in this market, sits on them, and then sells them in 90 days for hopefully a profit, that has got to be the hardest single business at this point in time in the world. That's why the stock's been crushed. But here's the positive side. If they make it through this, and they will, once they make it through this, they will prove beyond any reasonable doubt the viability of their iBuying business model and their pricing algorithms. That if they can survive this weird housing market of declining prices, where they're actually, recent data came out and showed that they're actually selling homes for less than they bought them. So if they can do that and still post positive gross profit because of that 5% commission fee, you have to remember on every one of their transactions, they take a 5% commission fee. So unless they are selling homes for 5% less than what they bought them, they're going to have positive gross profits. Homes don't decline 5% in 90 days. We've talked about this. Home prices are slow moving. Case-Shiller 20 price index down 0.4% month over month in July. The sharpest decline on record. Minus 0.4% over 30 days. That means home prices over a 90-day stretch are not going to decline more than 1 to 2%, 2% at the very most. Let's say the worst case scenario happens. 2% decline, 90 days, 5% commission, 5 minus 2 is 3. That's 3% gross profit. So Open Door should be able to maintain positive gross margins in this turbulent time. Granted, that gross profit base might not be large enough to offset their aggressive OPEX spending, so they probably will have negative EBITDA, but still maintaining positive gross profits in this market at a small scale. They only have 4 or 5% market share in their established markets and less than 1 to 2% market share nationally. That means that they have great pricing algorithms, but it also means that in 10 years, when the next housing crash arrives, they're going to have significantly more scale. As opposed to 4 to 5% in established markets, they're probably 10 to 15% in established markets. As opposed to 1 to 2% nationally, they're probably 3 to 5% nationally. That means that if that next housing crash happens in 2030, 2032, 2033, and the same thing happens, home prices decline 2% over 90 days, they're getting the 5% commission, minus 2, they have 3% gross profits. That gross profit base will be so big because their scale is so much larger, it's going to be more than enough to offset the OPEX base, and they're going to be hugely EBITDA positive. So I think right now, Open Door is in a prove it moment. And the market, because it's super fearful and super negative right now, is not believing in Open Door. But Open Door has an opportunity to prove its business model works in the worst of times for the housing market. And if they do successfully prove that, this is a stock that could be one of the biggest winners in any year ever in 2023 and in 2024 as the housing market normalizes and stabilizes. And as we get back into normal times for homes, which is they go up in value. So I think that Open Door do not expect anything short-term from it. That's a stock you're gonna have to wait for a Fed
Okay.
pivot, for capitulation, for it to start really working again. But once that happens, and if it happens on the heels of Open Door proving its business model can work even in this market, then that's a stock that goes from 3 to 6 to 9 to 12 to 20 to 30 to 40 in a matter of 2 years, honestly. So multi-year investors, buy the dip and hold your nose. If you're looking for the best entry point, it probably goes lower before it goes higher, so you have time to wait.
Okay.
That's my view on Open Door. But long term, still very, very, very bullish on that stock, and believe this crisis is actually an opportunity for a major catalyst for the stock in the next 12 months.
Okay.
Number 2, SoFi. SoFi is crushing it. I'm looking at their operating metrics. I'm looking at their search interest. I'm looking at web traffic. I'm looking at the app downloads. They're absolutely crushing it. The NFL season has been a huge tailwind for them in terms of brand awareness. I think that stock and company are doing completely fine. Student loan moratorium ends in 3 months. So a huge revenue tailwind comes back into the fold in 2023. Probably around the same time, the Fed is going to pivot. Probably around the same time, yields are going to collapse. Probably around the same time, the macro environment just gets better. Again, this is a stock that could really work wonders in 2023. Double, triple, quadruple in 23, totally possible. That's how cheap the stock is right now, especially if you throw in more growth firepower with student loan moratorium cancellation, which you will throw in undoubtedly. So love what's going on with SoFi. And then NEO.
So is SoFi getting hit like Open Door right now?
No, it's getting hit, but not like Open Door. Open Door is uniquely getting hit because of the housing market exposure. SoFi doesn't have housing market exposure. It has credit market exposure, and it has financial market exposure, and consumer spending exposure. So, and loan exposure. So it does have unique risk exposure that is creating weakness in the stock. But the housing market right now is like it's the riskiest of the risky set of phenomena in the market right now. So anything with exposure to that is getting hit uniquely hard. SoFi is getting hit, but not as hard as Open Door. And it simply doesn't have that much. It does have mortgage exposure, but very compared to its other business lines. So that's a SoFi story. And then NEO is unique because China has become just such a wild card that's differentiated from the global economy. The rest of the economy is hiking rates like crazy. They're providing stimulus to their economy. I don't know what's going on with the COVID policy. It's very weird. So, there's just a massive black box with the Chinese economy right now. Having said that, NEO is in the process of expanding beyond China and becoming more than a China story. They've successfully done European expansion. They're probably going to have North American expansion probably in 2023 or 2024. So the more they become a global EV story, the better the stock will do. And the less investors will view it as a China risk story and more as a global growth story. So I think that transition does happen over the next 12 to 24 months. I think the stock is really cheap down in the mid-teens. So I would be a buyer down here, and I think the stock goes a lot higher over the next 12 to 24 months.
Thanks for watching HGI Clips. For the full episode, head on over to our sister channel at Hypergrowth Investing by clicking the link in the description or listen to the podcast on any of your favorite streaming platforms. We make new episodes every Wednesday, so make sure to check it out and subscribe to never miss any of Luke's Hypergrowth insights.